Hey, what is going on, everybody? Welcome back to the channel all about real estate. My name is Lewis, and today we're going to be talking about the housing market having peaked. So we're going to be looking at the number of price reductions here that we are seeing in the housing market. We're going to discuss briefly how some of the buyers are standing on the sidelines and quitting the housing market. In addition to that, we're going to touch on the 30-year fixed interest rates to see where they are. Those two seem to have peaked, and they've actually come down a little bit. So we're going to take a look at the 30-year fixed interest rate. We're going to see how that actually affects the payments when you go to purchase in today's market. So go ahead and grab a cup of coffee, sit back, relax. Let's dig into the details here today. And if you haven't done so yet, please hit that like button, hit that subscribe button, and let's get right into the details. All right, so the first thing that I want to share with you here is the 30-year fixed interest rate. So up on the screen is the Freddie Mac website that gives the average 30-year fixed rate as of the week ending June 2nd. So this is pretty fresh data. Let's go ahead and take a look at what it shows here. So we have in blue, we have the 30-year fixed mortgage rate. The average is 5.09%. That's actually down a little bit from the prior week. That comes along with, on average, a 0.8% point structure, meaning that it would cost 0.8% in order to secure that rate on top of the additional closing costs. So it's based on the loan size. So if you had a loan amount at, let's say, $100,000, then 0.8% would be $800. That's what it would cost you to secure that rate. That's the national average. 15-year fixed is coming in with the same point structure at 4.32. So you get about 0.75% better rate if you go to a 15-year amortization, but obviously with the 15-year, the payment would be dramatically higher. And then you do have the 5/1 adjustable rate mortgage, which is coming in at just over 4% with 0.3% in points. Now, these ARMs are becoming increasingly popular. About 1 in every 10 loans are originated at this point with an adjustable rate mortgage. More and more people, and that actually, by the way, is a growing figure. It makes up about 20% of overall loan volume. But here's what I think is really unique. So we saw rates kind of peak out at about 5.3%. Now they have leveled off a little bit. They are starting to come down. And I'm wondering if that's because buyer demand has actually backed off a little bit. Now, even with the rates having come back down over the last week, the 10-year treasury yield has started to spike again. So let me go ahead and pull up a chart here. This is the 10-year treasury yield. You can find it on cnbc.com, and I'll go ahead and link to that in the show notes as well. This is a 5-day chart. So take a look at what it's done in just the last 5 days. We were at 2.74%, spiked up, spike up, spike up. We are now hovering just under about 3%. Now, usually when this 10-year treasury yield move, it does not necessarily mean it's an equal adjustment to the 30-year mortgage rates, but it does usually affect the margin on the loan. So even if the interest rate stayed the same, maybe the point or fee structure would increase on that particular rate. My suspicion is that based on what is going on in the bond market, we're likely to see higher interest rates next week just based on what the 10-year treasury yield has done. All right, now I have a property up on the screen that I just found randomly on Redfin. This property is a 3-bed, 2.5 bath. It's just under 1,700 square feet. It's priced at about $550,000. I want to walk through the steps of calculating the mortgage payment on this and show you how the interest rate actually affects the mortgage payment, because I think it's very important. So if you scroll down here, there's actually a mortgage calculator, and you can make some of the adjustments here. So let's go ahead and first start with the down payment. Let's say the average down payment is going to be 10%, let's say. So you're putting 10% down on this property, which is just about $55,000. Let's say the interest rate is 5%. That's currently the average. It's just over that, but let's just say 5% in this particular case. And then what we want to do is just make sure we have the other filters in there correctly. So property taxes about 1.25%. That's common for California. Let's just take out the HOAs in this case. Let's say the homeowner's insurance is $85, and then the mortgage insurance is about 0.35%. Now, if you have excellent credit, it might end up being a little less, but let's be conservative on this. So once we update it here, that particular property would cost you $34.55 per month. So about $3,500 a month, principal, interest, taxes, and insurance. In other words, you're all in figure on that. Now, I want to just go ahead and show you the difference with a 3% interest rate and what that would look like had you had made this purchase about 6 months ago. That property would have cost you about $2,886. Let's round up to about $2,900. So the difference there is $600 per month roughly. So that is the impact that we have seen on interest rates, and one of the reasons why the affordability levels are going down dramatically at this point. And as a result of this, we are seeing more and more buyers being sidelined and being pushed back into the tenant pool and being forced to stay renters because the down payment requirements are higher now because the purchase prices are larger, and then you have interest rates that have gone up dramatically, increasing the cost to borrow. And that's a pretty big difference. I mean, $600 a month might be what your utility bills cost you. And in some cases, first-time buyers don't plan or budget for these properly. I know that I certainly didn't when I bought my first house. So, that's another added expense that needs to be taken into consideration, because on a property like this, you're going to have electricity, you're going to have gas, water, sewer, garbage. On top of that, you're probably going to need some sort of internet or cable. Once you start adding all those bills up, I mean, you're talking maybe $500-$600 a month. So if your payment is $3,500 based on where the rates are today, then you have another $500, let's call it, in utility bills. That property is costing you $4,000 per month. Now, that price point in the Sacramento region is actually about the average right now. So could you imagine? I mean, you're a first-time home buyer. You have to not only save up $50,000 in this case to put down, but you're also having a housing expense somewhere around $4,000 a month. The tough part right now is that median household income is somewhere around $75,000 a year. It would be very, very hard to qualify for that property based on the median income. So it's getting further and further out of reach for most buyers, and that is why we are starting to see a lot of price reductions in this market. Now, I want to be clear, even though we are starting to see price reductions, the buyer demand is still absolutely there. I mean, these homes are still getting put in a contract on average in 2 weeks' time. There's still a big buyer demand. People want to own real estate. At this point, we have kind of like a flood of listings coming to the market. Inventory has increased pretty dramatically, at least in our local market, but it's still far under what we would consider a balanced, neutral, or a buyer's market at this point. So we're gonna have to continue to monitor this to see if we'll actually see prices soften. I know the Redfin CEO recently went and talked about him seeing prices soften. He expects mortgage rates to go up to 6%. If we do, it's certainly going to put some downward pressure on prices, or at least more downward pressure at this point. But anyway, that is the housing market update that I have for you here today. Just wanted to provide you up-to-date information on the interest rates, let you know what is going on in the market, what we're seeing. If you haven't done so already, please smash that like button, hit that subscribe button, and leave a comment below. The comments really help me as well as others learn and grow. Really appreciate you taking the time to watch. Take care.